Hello and welcome to Market Domination Overtime. Stocks closing lower for the second session in a row. Our very own Jared Blikre standing by with all the headlines. Jared.
Thank you, Josh. That's right. All the majors, all three, Dow, NASDAQ, S&P 500, closed in the red, but we've got some records to talk about, not in the large cap space, but let's tick through some of the majors. The leaders right now, Dow down about 41 points, very small amount to 49,150. NASDAQ down in the red the entire day, down about 1%. S&P 500 down about half of that. But here's where it gets interesting. S&P 500 equal weight index, that's where every stock gets one vote instead of being weighted towards the largest mega cap stocks. That was up today, 0.4%. Good for a record. Same for the Russell 2000, another record for the small caps, up 0.5%. And here's a different small cap index, S&P 600. I believe that's a record as well. And then the S&P 400, you like mid caps, we got a record there, although the gains just barely squeezing one out there in the end. Well, let's take a look at the sector action. Energy was the leader today, up over 2%. That is despite a late day sell-off at 3 p.m. based on some Trump comments there, but still retained the pole position, up about 2.3%. After that, we got staples, real estate, and utilities, and then healthcare. Industrials and materials, that rounds out the green ones. And if you're taking a look at the top row, that is mostly defensive sectors that we are seeing in the lead. So not the most bullish picture. And then at the bottom, we got consumer discretionary leading the way down. That's down 1.5%. That's where you're going to find Amazon and Tesla as the two biggest components. Then we got tech down over 1.2%. And then communication services and financials also down just marginally. But you take a look at the NASDAQ 100. Not a pretty picture. A lot of red, a little dark red there. Broadcom down 4%. That's an outsider. That was an underperformer. Nvidia down 1.4%. Microsoft down over 2%. So is Amazon and Meta. Tesla down about 1.8%. Intel, a bright spot, up about 3%. But for the most part, the tech trade going sideways to down today. Here we have the Dow, and we do see a little bit more green here. Some of the green ones are the defensive names that I was talking about. J&J, that's a staple, that's up 2%. Chevron, that's an energy trade. Merck up 2%. Verizon up 2%. That's in telecom. Although we did see some positive action in Honeywell. That was up 1.3%. List goes on. I'm going to lead us off with the leaders here. Bitcoin, real positive day in Bitcoin. Also biotech and Korea. So the chip stocks doing well for Korea, but not the U.S. today. So I'm going to leave it off on there, Josh, and I'll meet you back in about 30 minutes here.
Sure will. Thank you, sir. All right, the equity market closing off the lows of the day here, but the themes rallying stocks from Fed independence to fiscal policy, also rippling to the bond market. Joining now, we got John Velis, BNY FX, and global macro strategist. John, it is great to have you, especially on set. Big picture, let's start there, John, because you say something interesting. You say markets still expect a soft landing in 2026, but you go on to say the range of outcomes is widening. Walk me through that. What is, John, the big vulnerability or vulnerabilities that you think, okay, maybe we're underestimating?
This is a great question. So I would even say that right now we're expecting something better than a soft landing, maybe even some acceleration. If you look at kind of contemporaneous GDP proxies, they look really strong.
Atlanta Fed GDP 5.3.
Now there's some statistical problems. They don't account for net exports very well, and there was a big drop in that, so that flatters it. But if you look at final sales to final domestic consumers, it's like 3%. It's been 3% for the last 2.5 years. So we're on kind of trend, and a pretty high trend. The problem with the range of outcomes for me is, we could reaccelerate, particularly if earnings growth for companies picks up, as is somewhat expected. Employment can pick up. But my biggest fear is the labor market is really weak, is maybe not the right word, but it's moribund. We've got essentially zero job growth. The Beige Book today said firms aren't hiring in the regions that they anecdotally, qualitatively survey. So those sorts of things can still be downside risks. Then you've got a whole range of political policy outcomes that can occur to create some vol. We've got very low vol on markets these days since the beginning of the year. It's been crushed. So the catalyst for higher vol could come from geopolitics, could come from some out of left field policy announcement. We've seen a few attempts at those. I know some of your guests earlier were talking at those things. So the range of outcomes is very fraught to what happens in the policy space. It's a midterm election. Fed independence, you mentioned, is always a watchword these days. And so the range of outcomes is quite broad, and with markets as fully priced as they are, I don't want to say expensive, but fully priced, there's potential downside risk if things don't go perfectly. But if things go really well or close to perfect, yeah, we could have an excellent year.
About the labor market, I have heard some commentary, John, I don't know what you make of this. Some folks say this is the new normal. This is, it's 100,000 a month. That's rear view mirror.
Yeah.
Get ready for 40,000, 50,000.
It could be the case. Yeah. We don't have great numbers. We don't really have a great insight in real time what the immigration story is on labor supply. But I would argue, if you're only producing 40 or less thousand jobs per month, that can't be great for consumption in the economy. If you don't have more people working, creating income, generating hours worked, national income falls just from that one effect by itself. Now, it could be that we only need to produce that around 40,000 jobs a month to keep the unemployment rate steady, in which case this would be sort of the first time since the 50s that we've had that sort of an experience. But, this could be different because we do have a lot of things changing both in the policy environment and in technology and other innovations.
You mentioned tech innovation. What about the great AI trade and trend? How are you thinking through that in 26?
Well, I think what's interesting is it did really well in the first half of last year, but kind of the Mag 7 and the big hyperscalers sort of had mediocre performance relative to the rest of the market, certainly in the fourth quarter, maybe even the second half. We've seen that in our data. So we are the largest custodian in the world. We see 60-ish, almost $1 trillion in custody assets, and we can see where it's positioned in an aggregate way. And what we've seen has been a rotation out of tech, broadly speaking, and into things like financials and energy, where the earnings story is expected to be, industrials, where the earnings story is expected to be better than it was relative to the tech names. So I think the broadening of the market that was described earlier is probably something that we're going to see for the first few months of the year, at least, if not further into the year.
Finally, the Fed, John, I'm just curious. Questions are about Fed independence. Are you hearing that from clients given recent headlines? What do you tell them?
Hard to ignore. We tell them that, these are things that haven't been resolved yet. We've seen the risk premium on bonds rise really since November of last year, so not surprisingly. And our view is that, if anything, this could actually strengthen Fed independence because Congress is somewhat up in arms, or certainly defending Fed independence. So could have an ironic outcome.
Is that why, do you think, by the way, you haven't seen a better reaction in the markets?
I do think so. I think that's very possible. Now, it can go further. If it gets worse, who knows? All bets are off. But right now, we're still of the belief that even if there is a new chair named eventually, that it's one vote, and that the constraints of the economy, the reality of inflation and unemployment will ultimately dictate what they do, because it's a committee structure.
Finally, John, let's get you out of this. For fixed income investors who are listening right now, your advice, where do you see opportunity?
In non-US fixed income product, Europe, but really like Asia. Emerging Asia is particularly strong, both from a currency and a fixed income perspective. If you think about where our money from our client base is allocated, it's been overweight US Treasuries, overweight US fixed income. Again, like the sort of the equity trade, which broadened out to the rest of the world at the expense of the US in the second half of last year, that could happen in fixed income space as well.
John, great to have you,
Pleasure.
especially on set. Thank you, sir.
Thank you.
Coming up, oil prices reversing earlier gains as Trump comments on the situation in Iran. We'll bring you the latest on this evolving situation next on Market Domination Overtime. Oil prices sliding after President Trump told reporters that the protester killings in Iran have stopped. That's according to Bloomberg. Oil was initially climbing in today's trade, touching the highest level since October amid the unrest in the country. Joining me now on this, we've got Rebecca Babin, CIBC Private Wealth Senior Energy Trader. Rebecca, it is great to see you. So on the oil markets, Rebecca, you call this a repricing of geopolitical risk. You emphasize Venezuela and Iran. Two very different market reactions, you say. Maybe start there, Rebecca. Explain that for us. What do you mean by that?
So the initial reaction to what happened in Venezuela from the oil market was to reprice additional supply eventually coming back onto the market. It was a risk that we would see accelerating investment in the country and that would actually press crude lower. So although there was an event there that created uncertainty, the market kind of looked through what could have been an initial supply disruption of 200,000 to 300,000 barrels a day and looked out into the long term of what that would mean. In Iran, it's a very different picture. We're looking at uncertainty that could impact a significant amount of supply in the very short term should things escalate. They produce around 3.2 million barrels a day, which is significant relative to Venezuela, which was producing 900,000 barrels a day. And the impact in the short term would very likely be a disruption as opposed to an acceleration of supply. So although the events both created this massive headline bonanza, the reaction from the oil market was to see downside in crude due to Venezuela, while looking at Iran seeing the upside. So it's a very bifurcated response to the two events.
With Iran, Rebecca, despite all the headlines, why, in your opinion, has the reaction been, relatively contained?
It's a great question. And the question I get asked most is not, why is crude rallying due to Iran? It's why is crude not higher based on what's happening? And there's a couple really good reasons for this. And the first and foremost is we are set up right now in a market that is really well supplied. We're expecting inventory builds of 2.5 to maybe 3 million barrels a day in the first quarter of 2026. This is a significant buffer against potential supply loss. Now, does it actually stop a knee-jerk reaction if things escalate and we see infrastructure impacted in Iran? Not initially, but over like a 1-2 month period, that supply is going to provide a buffer. The second reason is OPEC still has spare capacity. They would like to be bringing back barrels that they are holding off the market if given the opportunity, which is another buffer. And the third reason is that really impacting energy infrastructure in Iran is nobody's first choice. The U.S. doesn't want to see crude oil prices higher, and frankly, Iran does not want to see supply impacted either, because that's their main source of revenue and impacts their biggest customer, that is China, who they need as an ally. So those three things packaged together really have offered crude a little bit of a buffer to an extreme or outsized rally that some would have thought would have occurred with these types of events.
So you've got that buffer, Rebecca. What then, though, could create this more material spike in oil? What would you be watching for?
So I think the first thing you would watch for is that the energy infrastructure in Iran is a military target, either from outside sources or internally. If the IRGC, which currently runs a lot of the energy kind of output there, turns against the country and decides to walk off or strike, join the protests, or is forced to potentially harm the energy infrastructure based on the pressure that's being applied to them, that is where you would see a very outsized reaction in crude, because that could be a long-term impact where the infrastructure is impacted. You get this longer-term impact that can't be resolved quickly. People will reference the Strait of Hormuz as a potential risk. I see that as an extremely low probability. I don't think Iran will, as a retaliation to something that the U.S. or Israel does, I don't think they will try to close the Strait of Hormuz. It hurts China, their biggest customer, and it would cause a significant global reaction. And I just don't think that that's something we should put in as a high probability. I know it's been referenced kind of on the media. I would say that the infrastructure risks are higher, and that's what drives crude into the 80s in Brent and TI. Another story I want your take on, Rebecca, is this interesting sort of tension playing out in Washington. And I'm just curious to get your thoughts on how President Trump talking about he wants lower oil prices because he believes correctly, hey, that's good news for consumers. That's good news for Rebecca and Josh. But at the same time, Rebecca, of course, that could complicate the economics for big oil. And I'm just curious how you're thinking through that dynamic. It's a great question, and it's a dynamic that's kind of been batted around now for several years. And the key here is producers in the U.S. are not going to produce oil at losses. So their choices, no matter how much political pressure is applied to them, they are public companies that need to serve their shareholders. They've become capital efficient. They have much less leverage, and they're very disciplined on production growth right now. They're going to make decisions based on economics, not necessarily necessarily entirely on politics. Now, there is a political element that can influence some of their choices, and we'll likely see that play out in Venezuela in particular. But at the end of the day, their big decisions on how much they produce are going to be driven more about where they are able to generate profits. And at $50 a barrel in WTI, it's very difficult for many of the producers to make a meaningful profit. So I don't think you see producers stepping up to increase production at those prices. That's not to say the rhetoric won't continue, but I do think if we look through and we look at the motivation, the driver is not going to be politically motivated.
Finally, Rebecca, I'll just get you out here on this. Let's get a number on here. I got WTI at 60. Your clients ask you, Rebecca, they say, okay, Rebecca, what do we think? Where is that headed? Near intermediate term? You tell them what, Rebecca?
So I'd tell them right now, if you were going to say how difficult it is to trade crude oil and you're using a skiing analogy, it's a double black diamond. So unless you're ready to ski a double black diamond, maybe you don't make a bet in crude right now and you wait and see how things play out geopolitically. Besides that, if we take away that kind of element, I'd say that the risk right now is that we drift lower. We are fundamentally oversupplied in the first quarter. Positioning, which was extremely short, has been mostly neutralized with this most recent rally. So I see the market settling in a place of around 55 to 60 WTI. That doesn't mean we couldn't get knee-jerk reactions lower or higher from there, but I would advise that unless you have a high degree of risk tolerance, that right now might not be the time to make those kind of trades. You need more information on geopolitics because the volatility, as we saw today with a 4% high to low move, is not for the faint of heart.
Rebecca, always so good to have you on the show. Thank you.
Thank you.
Well, OpenAI has taken early steps to go public. That's according to the New York Times, potentially joining other high-valued startups like Anthropic and SpaceX to make 2026 a mega year for IPOs. Here with more, our very own Laura Bratton. So, Laura, Sam Altman has said he is 0% excited about leading a public company. What do you make of that?
Yeah, I think there's some nervousness about what OpenAI publicly releasing some of its earnings statements would bring for the company. But OpenAI needs to raise capital. It needs money. It's committed to about 1.4 trillion worth of commitments over the next 8 years. And at the same time, its revenue reported by the Information in the Times was just about 13 billion. So there's really a gap that it needs to fill. And going public could help sort of like narrow the gap. In December, they were in talks for a private funding round valued at about 750 billion, putting the company at a 750 billion valuation. And the New York Times report said that OpenAI would be valued at 500 billion. So I'd be curious to see what that valuation ends up coming in at.
Also, you had this other story where Apple decides, okay, we're going to go with Google over OpenAI for our AI features. What do you make of that?
Yeah, so with the release of Gemini 3, that really put OpenAI on edge. Sam Altman declared a code red, and that made news. And so, OpenAI had seemed poised to partner with Apple because they had that partnership. Apple rolled out ChatGPT on iPhones in 2024. But then OpenAI appeared to take a swing at Apple by, merging with the startup of its former chief designer, Johnny Ive, and they're trying to
Johnny Ive.
Yes, Sir Johnny Ive.
Yes.
And they're trying to release a consumer hardware device. And analysts sort of speculate that put Apple on edge and pushed them towards going with Google. They also have the benefit of, leveraging Google's infrastructure. Google has TPUs or AI chips. They have the cloud. And so, OpenAI is really losing out on distribution here. It's going to be big for Google to have that brand visibility being on every iPhone in the world.
So plenty of competition. What's a win for OpenAI in the year ahead?
Yeah, there's a lot that OpenAI could win. There's a lot of concern in the market about OpenAI succeeding, whether it will succeed or not. They really need to find a business model that will work. Right now, OpenAI is essentially subsidizing users, and at some point they're going to need to generate revenue, whether that's figuring out the ad format that's going to work for them to generate ad revenue, or pushing further into the enterprise space. That's really something that Anthropic has gone super heavily into. And they need to release new models that are on the cutting edge that can rival Google, and so as not to get displaced by Google. And then the last thing I'll say is that they really need to secure enough power for their data centers, because that's a concern that there's not going to be enough power in the market for these data centers. And then, that's going to have ripple effects across the entire market, because OpenAI's growth is really important for companies like Oracle and CoreWeave. OpenAI has deals across the ecosystem, so it's really important for OpenAI to meet its goals.
All right, Laura, thank you. As always, appreciate it. All right, time now for what to watch Thursday, January 15th. We're going to start off on the earnings front. We're going to be hearing from more banks, including Morgan Stanley and Goldman Sachs. Morgan Stanley announced results for the fourth quarter before the markets open. Analysts expecting the big bank to have a strong Q4 with that momentum carrying into 2026. Wealth management and investment banking expected to drive strength for the quarter, while net interest income set to rise modestly quarter over quarter. We'll also be getting earnings from Taiwan Semiconductor. Analysts see TSMC's profitability hitting the highest level in 3 years. AI demand is booming, and Taiwan Semi may guide capital spending to $48 billion or more in 2026. And taking a look at the Federal Reserve as well, got a big batch of Fed commentary coming on Thursday. This is coming after more political pressure from President Trump on Tuesday. Trump talking about Fed Chair Jerome Powell, saying, quote, "That jerk will be gone soon." Yahoo Finance's Jennifer Schonberger is interviewing Fed Governor Michael Barr at 10 a.m. Eastern. You won't want to miss it. Moving over to the labor market as well, fresh data is releasing on Thursday with initial jobless claims. Economists forecasting the number of claims to rise compared to the week prior to 215,000, signaling more people are filing for unemployment benefits, but claims still historically low. Well, that's going to do it for today's Market Domination Overtime, but don't go anywhere. On the other side of the break, it's asking for a trend.